Good day, ladies and gentlemen. This is Barry Norman on behalf of USG, and welcome to our webinar on fundamental analysis. Now, today's class is sponsored by the world's leading provider for Forex trading, and that is USG. They are one of the only Australian Forex regulated providers offering trading of Forex, commodities, and indices, and again, a trusted Australian broker. They are authorized and regulated by the ASIC, that's the Australian Security and Investment Commission. All your funds are segregated and kept in a separate client account with the Commonwealth Bank of Australia. Withdrawals are processed within 24 to 48 hours, and you get extra fast execution, up to 12 times faster than on a normal platform and 10 times lower latency. That means you execute your trades at a faster rate, at a closer to your quoted price, and you also have negative balance protection. They offer leverage up to 500 to 1. They have very low spreads and slippage, and you can open an account with a deposit of 100 Australian US dollars. To their traders, they offer many different types of support material. You can get professional charts, trading alerts, and technical analysis tools with your account. USG is one of the award-winning providers. They were elected or voted best Forex provider in Australia in 2015, 2016, and also in all of Asia in 2016. They offer many different types of services and platforms depending on your needs and your desires. So when you trade with USG, USG FX, you get an online brokerage firm that offers currency and CFD trades. You have a global company that is headquartered right there in Sydney. You can trade on the Forex 60 different types of pairs. You also can trade contracts for difference on equities, indices, commodities like gold and silver and oil. They've been open and operating since 2006. They're one of the longest online providers in the Forex industry. And once again, they are regulated with the ASIC with license number 302792. They offer many different types of trading platforms. You decide which ones you want. You can use them all, or whatever is best for you. They'll make sure that you understand, you're trained, and you're knowledgeable about each different platform they offer for you to trade on. You get daily technical reviews. You get MT4 signals directly to your platform. You get online technical research and live Forex TV. So everything you could possibly want is available when you trade with USG. And as a special webinar promotion, if you open up a deposit with $5,000 in capital, they'll give you a $500 bonus plus all their advanced services at no charge. Now, today's class is on fundamental analysis, and the class is being recorded. If you'd like to access a recorded version of this class after the webinar, give us about 24 hours and it'll be available for you. And you just use the same link you used to attend today's class. So let's talk about breaking news and how you can make possible profit. So how do you trade economic news, and what is classified as economic news? Trading news can be very profitable if you can correctly guess which way it's going to move. Price can move 30 and 40 pips very quickly in big news releases, but knowing which way it's going to move is very much a gamble. So most traders do not trade the news, as it's just too risky, and you often get stopped out as price moves one way and then the other. Most traders have experienced this whipsaw effect when prices go up and down very quickly. So it seems no matter which way you trade, you can always get stopped out. But when it comes to economic releases, the market can react volatilely as traders enter and exit positions based on the new information. Some news releases are more important than others, like the NFP, the non-farm payroll release report that's released this Friday, inflation data, and of course central bank announcements. They typically move the markets all over the place. Now, this is for good reason. Central bank announcements like rate hikes directly affect money supply, which has a major bearing on the economy, while CPI, that's inflation, figures or unemployment numbers can influence central bank policies. Now, remember, these days, sophisticated algorithms are able to process news releases in a blink of an eye and move the market accordingly. Financial markets, therefore, adjust quickly to new information. Even so, the biggest news releases create opportunities in the market because they cause long-lasting price movements and momentarily distort the efficiencies of the market. Now, that being all said, a good, smart trader has to have a strong understanding of how the economy moves, how these economic moves will affect a particular currency, and why. Too many traders just think, oh, if the jobs report is good, it should send the Australian dollar or the New Zealand dollar or the US dollar, whatever country, upward. If the market's disappointing, it should send the market downward. Okay, well, that's an instantaneous response, but that's not how you would evaluate the news, how you'd evaluate the economic data, because that's only, a knee-jerk reaction. One has to understand how all of these events tie together and how U.S. manufacturing data being released today can help us determine ahead of time what we can expect in Friday's jobs report and why the data today could help us with a leg up tomorrow. Because they're all tied together. They're not independent reports that just tell you something about one thing and have nothing to do with the other. And sometimes when a report is better than expected or worse than expected, you expect the markets to go up or down, but it doesn't happen. Why? You need to understand these. Okay. Now, the first thing is you need to know where to get all this data from. And economic data, news events, headlines, press releases, even the horrible shooting in the U.S. yesterday, have an effect on the markets. And this falls in a category called fundamental analysis. Because there's two types of analysis. You have technical analysis, which is using charts and algorithms and indicators and oscillators to foresee or see a pattern in price movement, where fundamental analysis is used from events, speeches, geopolitical turmoil, and economic data releases to evaluate the markets. Now, the big difference is fundamental data can help you determine where an asset should move up or down. It can't really help you determine what level it should go to, where you should put your stop loss and your take profit. But it can tell you that the Australian US dollar should be going up, or the euro dollar should be falling down. Okay, it will give you some indication. Okay, it won't necessarily give you entry points, but it'll tell you, okay, there's an opportunity here. Then you should apply technical analysis to determine where the next level of support and resistance are, maybe to help you with an entry point, where to put your stop loss, because fundamental data doesn't do any type of calculations. Just like when you get an earnings report from Apple and iPhone sales are sky high. Okay. Well, you think Apple's going to go up, but when you determine how far Apple should go up, the report doesn't help you with that. So the fundamental analysis can give you only certain things about a market and about a price. Now, when you apply fundamental analysis and back it up with technical analysis, you become a very good trader. Now, most of the technical analysis that we see comes from what we call, I'm sorry, I'm having a problem with my mouse. There we go. Okay. Now, the economic calendar is where we get most of this information. The economic calendar is published daily and is the main trading tool for traders using fundamental analysis, as it signals for entering and exit trades. Economic and political news can change the direction of a currency pair in seconds. And fundamentals that are true in one instance can be rendered absolutely meaningless with fresh fundamentals a second later. So believe it or not, there are a large number of amateur traders who ignore news events and economic releases completely. They concentrate solely on technical indicators and chart patterns. Then they wonder why the market spiked violently against them in the space of a couple minutes. So imagine you're using technical analysis. You've looked at your chart. You see this beautiful triangle developing. You're looking for a breakout. You see your RSI and your MACD indicators all working in divergence. Everything's telling you, okay, let's get a trade on this asset to go down. Everything's told me that the uptrend is over and I'm going to enter this trade going down. You enter that trade, but you didn't look at the calendar and didn't realize that there's a speech by Mario Draghi coming out and he's going to pump euro, and he sends the euro climbing, even though you were completely right in your decision, and later today or tomorrow, the euro went to where you thought it was indeed. You got stopped out because the euro went up and went down, went crazy in that section of time. So if you're not even trading from technical fundamental analysis, you should be aware of the events unfolding, because it can give the markets a tizzy for a very short period of time and make everything you've done wrong, only because you said, you know what, you should have entered that trade a half hour later, because you don't want to put your stop loss and risk all of that higher risk during that volatility. So even if you're going to be strictly a technical analyst trader and a chart trader, you still can't ignore the schedule on the economics calendar. Now, other traders acknowledge the importance of news releases, but they see them as unpredictable and too risky to trade. For the most part, they have been taught to trade during quiet markets and to always act when a news release is coming out. Well, I don't know, and I don't know how many of us actually believe in that. Okay, I want to be prepared for a news release. I don't want to be in the markets with a trade or a longer term trade during those news releases, or I might want to adjust my stop loss to let me stay in that market through that swing. But in truth, there's nothing wrong with this approach. News releases are certainly unpredictable, and they can turn your winning trades into losers if you're not careful. However, I have always been taught to study fundamental, and news releases offer good trading opportunities so long as you are selective and disciplined in your approach. Now, economic data tends to be one of the most important catalysts for short-term movements in any market. But this is particularly true in the currency markets, which responds not only to U.S. economic news, but also to news from around the world. With at least 8 major currencies available for trading at most currency brokers, that's just the major currencies, that's not all the cross pairs. Okay. And at least 17 different derivatives of them, there's always some piece of economic data slated to be released. Trading the news is harder than it may sound. Not only is the reported consensus figure important, but also the whisper numbers and the revisions. And we'll talk about them. So those of you who don't understand what they are, we'll talk about them in a little bit to explain to you how to better understanding these. Also, some releases are more important than others. This can be measured in terms of both the significance of the country releasing the data and the importance of the release in relationship to the pieces of data being released at the same time. But first off, markets move a lot more in line with what the expectations for a coming economic event news release rather than the actual news release implies. Meaning, because traders trade their beliefs about upcoming news events, often when the actual news event or news release happens, the move is either over or ready to come back roaring in the opposite direction than the actual news report. This is why you may have heard the term buy the rumor, sell the fact. Now, that all sounds great. But unless you understand what these events are and why they tie back together and how to analyze the importance of the event and how it might affect the market, then you're just stabbing in the dark. I mean, I teach a class, Trading the Economics, where I teach you how to build a matrix for short-term trading, where you're just looking at the individual news release. But a smart trader understands how this release is tied to other releases and doesn't look to trade that 15 minutes of volatility. He looks to trade the longer term effect. Because if the data is positive, the US dollar should be climbing up. Yes, sure, it can be very volatile over the next 15 minutes or 20 minutes, but it'll eventually end up at a higher level. And sometimes this longer strategy, which is still within the day, is still much better than trading that knee-jerk reaction. But you have to make decisions based on knowledge and intelligence. So we have a standard set of data that's very important. And this data is released by every country in the world, because this is what the economy is based on. And of course, the currency of that country functions based on the economy. Then understanding what assets are affected and why they're affected can help you understand and figure out what asset you should be trading. Just because it's a data out of China doesn't mean you should be trading the Chinese yuan. You might want to be trading the Australian dollar or the New Zealand dollar, because they're the largest trading partners with China. So if that data is positive on import-export data, it's going to help the Australian dollar and New Zealand dollar. So you have to understand these events and what their overall effects are in the market. So lots of people say, well, 2% inflation data came out a little bit better than expected, so I'm going to trade that asset going up. But they don't understand what inflation is. So you have to understand how all of these work together. So changes in market inflation cause changes in currency exchange rates. A country with a lower inflation rate than another will see an appreciation of its value of currency. Why? If you had 400 Australian dollars, and the Australian dollar is trading at, say, 75 to 1 for the US, 75 against the US dollar, and Australia had a very low inflation rate, so you could go in and you could buy 2 weeks worth of groceries for your 400 Australian dollars. Well, if inflation goes up in Australia, now you get the same groceries you need to put in your cart as you did 2 weeks ago, but it's now costing you 410 Australian dollars. What happened is, in the US there wasn't inflation, so in the US you're still getting the same amount of groceries for whatever you paid for them. So the Australian dollar is technically worth less today because it cost you more to buy the same thing you did before. So the price of goods and services increases at a slower rate where inflation is low. A country with a consistently low inflation rate exhibits a rising currency value, while a country with a higher inflation typically sees depreciation in currency. Now that's textbook explanation. It sounds great, doesn't it? Well, the fact is, we are going through, and we have been since 2007, a very weird financial crisis where inflation fell down to zero and to negative in some countries. So now what we're trying to do is see increased inflation. Why? Because we have to get up to where it's a 2% level. 2% is the worldwide accepted standard. Okay? Because you need to have inflation. Inflation is increase in cost of goods, because a manufacturer needs to increase his cost of goods. He can't increase his cost of goods having a bad effect on the economy unless the employee is getting paid higher wages, or you have and when you have low unemployment, employees can demand more money for their job because there's less people available to take that job. They get an increase in their wages or their hours worked. They don't mind spending more in a grocery store. If eggs went up from 21 cents to 22 cents, but their salary went up from $100 a week to $105, they're not going backwards. Okay? Means that the farmer can charge more for his eggs. He's got more money in his pocket. He can pay more for his egg. And the cycle turns. And we need this cycle turning. In Japan, where inflation, they haven't been able to increase inflation for years because no matter what the central bank does, the employers won't increase wages. When they don't increase wages, they can't charge more money for money for goods. And so you end up with deflation or recession, because when the Japanese government increased taxes a couple years ago, they were hoping that at the same time they would get wage growth. So what they got was just the opposite. people weren't getting any more money, so it means they could buy less stuff at the grocery store, which meant the manufacturers were getting hurt in the retail store. So they offered more QA and more stimulus money, but the manufacturers put the stimulus money in their bank account in their pockets and still didn't increase wages. So they're stuck in this vicious cycle. So you have to understand how all of this relates together. But ultimately, it's where the central banks are going to go at interest rates, because everything is tied back to what a central bank will do. So changes in interest rate affect currency values and dollar exchange rates. Forex rate, interest rates, and inflation are all correlated. Increases in interest rates cause a country's currency to appreciate because higher interest rates provide higher rates to lenders, thereby attracting more foreign capital, which causes a rise in the exchange rate. If you're a private investor or you're a hedge fund and you've got to park your Apple with billions of dollars, you've got to park it somewhere because it hasn't been invested at the moment. You're going to park it where you're getting the highest overnight or short-term interest rate. This is all based on the central bank's rates. Now, they have to take in risk, how much they can transfer, taxes and everything else, but that's how they figure out where they're going to park their money. I mean, back 40 years ago, I had a job just for Crown Zellerbach, who was one of the world's largest lumber fraud, moving all of their money around, and that's before we had the euro. So we're moving their money around from bank to bank, currency to currency, to make sure we had enough of the right currency to pay the right bills, but also that the currency was improving in value, or the interest rate they would be giving overnight on our deposits was high enough. Okay, and it's a balance. And you think this shift can shift billions of dollars, okay, and makes a big difference on the country's economy. So does balance of payments and current accounts. A country's current account reflects the balance of trade and earnings of foreign investments. Then there's government debt. Why does government debt really make a difference? Well, if it's all about where the foreign flows of money are going, where are you going to go? Okay, even though a country's paying a higher interest rate, if there's a problem with their debt, or their debt is too high, their risk gets higher. Or if you're selling bonds, government bonds to help that country grow and give them the cash they need, and the bond rate goes up because the government debt is too high. We saw what happened just recently in Greece was the textbook case. Bondholders don't want to take haircuts. Okay, they want to put their money where it is safe with a solid basic interest rate where they don't have to worry, because they're just looking at this money coming back or this interest coming back year after year after year. They're not looking at 6 months or 2 months. They're looking at where they can park billions of dollars for a long term. So foreign investors will sell their bonds in the open market if the market predicts government debt within a certain country. As a result, a decrease in value of its exchange rate will follow. Then we want to look at terms of sale. This is how one country does business with another. This results in higher revenue, which causes a higher demand for the country's currency and an increase in the currency's value. Now, all of this is not just understanding if you trade Forex. This affects the stock market, it affects indices, and it affects commodities. So all of this will apply to whatever you're trading and however you're trading. Who would have thought? We all read the headlines. I'm sure everybody sat here and watched the news, watched all those horrible videos out of Las Vegas. But what do you think happened as a result of that in the markets? Well, if you were an intuitive trader, you could have gone in the markets first thing this morning and traded some of those casino stocks. What do you think happened to the parent company who owns Mandalay Bay? What do you think happened to all of those casino stocks only because of this slight, horrible as it is a short-term tentative reaction because Las Vegas, they're predicting that maybe tourism and everything else in Las Vegas will drop for a while. That's going to affect the big hotels. It's going to affect the profit in those big corporations. Therefore, the stock in those corporations fell this morning. Now, if you understood how all of this related, you might have been able to get, unfortunately, on the back of a very bad thing, some profit. Now, to understand these economic events and how they do affect the trading, I tell you about a story about your kids and their report cards. Because each economic event, each major, now we're not about geopolitical stuff, that and unpredictable stuff, like Las Vegas was not predictable. But when we're talking about the events on an economics calendar, they are timed, they're on a calendar way ahead of time. Now, central bank action is almost like news headlines. It can't, there's some market acceptance because of speeches and everything, but nobody knows exactly what's going to come out of that central bank until that meeting is over. And so therefore it becomes a different trade than inflation reports, data reports, because these data reports have what we call expectations and whisper numbers. We know exactly when the data is coming out. We know exactly what's expected. We know how it was last month and the month before. So if you want to take advantage of maybe trading this, you have to understand that the data that's released by the government, or a lot is released by private agencies, isn't analytics data. Nobody is analyzing this fundamental data. They are releasing hardcore numbers. And these numbers have not been developed for the Forex trader. Every economy and every government has to release these numbers because they're important to every type of office around the world. Yes, when we release the non-farms payroll report on Fridays, that's important to the markets. It's important to the dollar. But if you're in the healthcare industry, you're only concerned with what is in that little sub-report, maybe about healthcare. If you're something, if you do something in senior care, you only concerned with that little report on this, but you're not even concerned how many jobs were offered. Maybe you're concerned with how many seniors were employed this year, this month, as opposed to last month. Having nothing to do with the overall markets itself. Because this data is accumulated by agencies or governments to statistically analyze every section of their economy. Now, in the Forex or the trading market or CFD market, we're looking at these reports because they are graded. There are major reports that have a big effect on the market, and there's lots of minor reports that have no effect on trading at all, but will have an effect maybe on a particular stock or a particular sector. You know, if some odd thing in construction is really bad, it won't have an effect on the US dollar at all. It won't even have an effect on the S&P. But if you're one of those few major home contractors, it might have an effect on that side, or it might have an effect on the stock of those homes. Or, you know, if new home sales are down, but previous owned sales are up, the housing market could be booming. But the fact is, maybe Home Depot or B&Q aren't doing well because people aren't doing new construction jobs. Or maybe you say, okay, they're buying used houses, so they're going to be buying lots of paint and stuff to fix up those new houses. So you have to understand what part and where it fits in and how it affects. But the fact is, these major events have a universal effect on the overall markets. And every event what's the word I want to use? Is put in tiers. It's rated. And we have top tier events, second tier, and there's 3 tiers, and they're universal. Now, tier 1 events don't usually have an effect on the markets. Tier 2 events can have a slight effect, but most tier 2 events are attached to a tier 3 event. In other words, when we get retail sales data, we get retail sales, core retail sales. Okay, so retail sales is the level 3. Core retail sales is taking out automobiles, boats, and big ticket items, so we can actually see how the overall retail sales market. So one is rated as a 3, and one's a subset of that major report, and it's rated as a 2. But regardless of the level, we have to understand how these events work for the markets. Because when we talk about whisper numbers or expectations, this is what happens. Since all the data is scheduled, the releases are scheduled, there's nothing sneaking out ahead of time, and it's like their kids in their report cards. So what happens is, you sit down with your son, your kids at dinner on Sunday, and you say to your son, hey kiddo, report cards are due on Wednesday. How do you think you did? Now, This is called the expectation, because the markets have not just what they got last month. There's something that they're based on their expectation. And these forecasts or whisper numbers are what we're expecting. So your kid, who you trust very much, he's very honorable, he's been a good kid, he doesn't get in trouble, and he's very straightforward with you. He says, well, Mom and Dad, if you remember last semester, I brought home I brought home 5 C's and 5 C pluses. They said, yeah, we remember. He said, okay. He said, so I think I did a little bit better this semester. So what do you have? You now have what's called the previous. This is when the report was released the previous time. We now know the report is due on Wednesday. So your son says, well, I think I did a little bit better. I think I might bring you home maybe 7 C pluses and only 1 C. So I think I did overall a wee bit better this semester. Now, because your kid is reliable, we've now set our expectations. So on Sunday, we've set our expectations to 7 C pluses and 1 C. And we've adjusted our viewpoint accordingly. And this is what happens in the market. When the forecasts come out, several days before the event, the markets adjust the value of the assets involved to what the expectations are. Now, come Wednesday, your kid comes running in the front door and headed out the back door to go play soccer, hands you the envelope with the report card, and you open up his report card, and it's all B's. You're shocked. You're astonished. You're just amazed. So you open up the back door and say, hey, kiddo, we're going to go over to the sporting goods store. You can get that new ball that you wanted, and then we're going to go out to dinner to celebrate. Why? Because the response or the result was much better than your expectations. Now, if he brought you home 4 C pluses and 4 C's, you would have had a much more negative response. In fact, you would have a big index, because you would say to him, hey, kiddo, you told me you did better and you got me the same grades as you did last, because you've now adjusted to the expectation. So when the report is better than you expected, you have a much stronger market reaction. When it is less than expected, not less than what it was, less than what's good, only less than expected, you have a negative reaction, because the assets have already adjusted to the expectation. Now, you're putting dinner back in the refrigerator. You're getting ready to go off to the sporting goods store as the soccer ball comes in that back window. Shatters the glass. You open the door and tell him to get his butt inside and help clean up. There goes the sporting goods store. There goes going out to dinner. There goes all your elation, because just that fast, something else happened that killed that elation. Now, later tonight and tomorrow morning, when you're past fixing the window and cleaning up the mess, you go back to being positive, because, you forget about the window because it's all fixed. And remember, he brought me home all B's. That was still pretty good. So the markets then adjust. But you can never be sure what's happening in between. So what you have to do is you have to learn to build what's called market neutral. That's the area around where a release will come that won't have an overall effect on the markets. Then you have to, and that's taking into account the expectation. Then you have to build what you call market negative. Market negative is where you would expect the asset to decline. It would have a negative effect on the trading. And then market positive is where it would have a very positive effect on the markets. And this is built using the expectation. Okay. And it's one way to help you start evaluating. It's not to help you start trading. It's one way that you want to start evaluating. Because the most common way to trade news is to look for a period of consolidation ahead of the big number and to just trade the breakout on the back of that number. This can be done for both short-term and intraday basis and daily basis. Okay. So you have the knee-jerk reaction. Now, what most traders don't understand, there are ways that you can turn this into safe trading. using special types of order execution. And you have to learn all the different styles of order execution, because you can set up ahead of time a buy and a sell order. And you can have first in, execute, set up the system where if it executes one, it cancels the other. Or you could set up a buy order above the next support level and a sell order below, and take advantage of both moves in the market. And the market will execute these trades as the asset's bouncing up and down. So there's many different types of order execution that are part of a strategy on how to trade these. But you get consolidation and knee-jerk reactions. Okay. This chart illustrates the indecision of the market leading up to the October non-farms payroll report. Okay. So when you see indecision prior to the event, because one of the best ways to trade is to read what the traders are doing before the event, especially things like the Federal Reserve meetings. Because if they think the Federal Reserve is going to be hawkish, you may see gold easing down. They're taking position ahead of the trades, and then they're going to exit as soon as that result comes out, and they can make some quick profit. But you're going to get this initial knee-jerk reaction. Okay. Now, trading news can be profitable if you can correctly guess which way it's going to move. Price can often move 30 or 40 pips on very big, quick releases. So you have to learn first how to build the trading matrix, determine whether it's market neutral, market positive, market negative, where you would set these expectations, because you need to quickly grade these events as they happen. Now, let's see, we have this week a very important report. It's the Friday non-farms payroll report. It is the biggest report of the markets. It comes out the first Friday of each month, basically, for the U.S. jobs report. Now, we can see that the top tier data report is the jobs report. Okay. And we can see that's level 3, and so is the unemployment rate, level 3. Those are red here. Okay. Now, what we have to do is first we have to sit back and understand this report. We have to learn it inside out. Because many people just say, the consensus, which is the expectation for the jobs, the non-farm payroll report, is 98,000 jobs. The previous is 156. 98,000 jobs is very, very weak. But again, the economics count isn't about weak or strong. It's what we're expecting. Okay, the data isn't an analysis, just true hard numbers, number crunching. Now, there are many reasons for this drop. Okay, we had the end of September. September is the end of summer season, so you have lots of people who are laid off. You have lots of and the hiring for the winter Christmas season doesn't start yet. We also had the 2 massive hurricanes, which might have affected all the hiring throughout Texas and Florida, which could have a big effect on the market. But we're expecting 98,000 jobs. But you see there's 1, 2, 3 level 2 reports. Now, right now, 4.4, 4.3, 4. Is an incredibly great unemployment rate for the U.S. That means everybody is working. That means everybody looking for jobs basically has jobs. People aren't getting laid off of jobs. Everything is good. So what are we looking at that's more important right now? We're looking at 2 things: weekly average hours worked and our average hourly earnings. They're secondary reports. But we want to see is that people are getting more hours, because even though you're getting hired and you're on a time clock, if they're only hiring and giving you 35 hours, but now they're giving you 40 hours, that's important because you're making more money or taking home more money. And we also want to see the increase in the average hourly earnings. That means people are getting raises. So we have to decide how we're going to evaluate this. Now, anyway, the top 2 level reports are still the most significant. But we have to then look at what we consider very important to make this determination. But the fact is we have all this data a week ahead of time. You can start doing an evaluation, and it becomes a complex evaluation of what assets, and this would be basically a good report will affect the S&P, it'll affect the Dow. It'll have a positive effect on the dollar. It'll have a weakening effect if it's a good report on gold. So you have to decide where you would find this report and what asset you would want to trade, and then how much importance you're going to give to each one of these events over the other. So you have to do your research. So there's many different ways to get short-term and long-term trading decisions out of this. But here's a fairly easy 5-step process designed to help Forex traders assess market conditions. So the first thing we want to do is observe price leading into the announcement. Approximately 30 minutes before the announcement, the trader can plot support and resistance levels based on price action. This can be done by observing the past few hours immediately prior to the release and drawing a rectangle around the high and the lows that was hit during this period. This can be done on a 5-minute, 15-minute, or 1-minute chart, and the high and low of this period will be the same. If looking for the maximum movement, often one of the major currency pairs, any currency with the US dollar, will suit that need. If looking for a more conservative approach, cross pairs can certainly work as well, pairs without the US dollar. You need to determine the assets that will be affected by the release. Then to step 2 is we want to identify the support and resistance levels around the current price. That will help us set entry and exit points. Okay. We want to understand when this number comes in, where the rally should go and what level it should, because we only want to enter that market if that rally was achieved and pushing it above that support level, okay, or that resistance level. If it's a negative report, we want to make sure that rally or that decline is strong enough that it'll break its next support level and keep on falling. So we want to determine where the support and resistance levels are. Now that we've plotted our support and resistance based entirely around the price action taking place leading an announcement, we can begin to set a game plan. The one thing we knew for certain going into a news announcement is there will probably be volatility. Predicting which direction that volatility may move is what makes trading news difficult. But we don't need to know the direction the volatility will push prices as long as we set entry orders on either side of the support and resistance. Now, the important thing is managing your orders. What if price comes down to open up your short position, then moves directly back to the prior resistance to trigger up us in a long position? So for traders in the US, which we are not, we're out of Australia, where we have a first in, first out execution, is standard. It may close out our short position at a loss. So going into the trade, if you know how you would want the situation handled. But that's fine. That's for the US market. In our markets, we have one cancels the other, OCO orders. If you like the entry order to go long to be canceled as soon as the short position is entered, or vice versa, you can set it one cancels the other, an OCO order. That way, when the short position is entered into, the long entry gets canceled. It doesn't get executed. So the system automatically will execute whichever one is achieved first and cancel the other one, because you don't want to have one in either direction. This can be done very easily from the platform. After all orders are entered, you can click on the tab for trading on the platform, then choose orders followed by a complex OCO. You can also do things like trailing stop losses, that you'll keep moving your stop losses. There's all types of order entries that you can do. It's understanding this and learning this ahead of time. Initially, all entry orders will show in your top box. We can simply highlight the orders we want to be part of an OCO order and add them into this system. But next comes the important part, is stop losses and adding stops and limit orders. Because we are anticipating volatility during a fast-moving environment, it benefits us to add proper risk management parameters. Remember, risk is the most important thing that you can manage. And always be aware that the markets can move against you. Okay, and risk is very high. So cover yourself with stop losses and using your risk management. Don't get involved in too big a trades because you think, I'm going to get rich. We have to keep in mind that the #1 mistake Forex traders make is risking too much to make too little. Despite lofty winning percentages, that type of inverse risk-reward ratio doesn't allow for much long-term success. Traders are right more than 50% of the time, but lose money on losing trades, more losing trades than they win on winning trades. Traders should use stops and limits to enforce a risk-reward ratio of 1-to-1 or higher. I personally use a 1-to-3, but you have to determine that through your own trading plan and your own risk management, depending on your skill, your level of ability, how much you have in your portfolio, how much experience you have, okay, and how much of this capital you could afford to lose. Because we have identified support and resistance levels previously, when setting up our entry orders, we can look to place our stop on the other side of the range. So for a short entry, look for breaks of support and stops can be placed slightly above the resistance. And for long entries, hoping that the breaks of resistance and stops can be placed slightly below support. Also, profit targets and limits should be at minimum 100% of that amount. If you are risking 50 pips on your target idea, look for a minimum of 50 pips to make sure that is worth your time. In other words, you've got to place your stops so close that your stop is not enough to let you, but your profit won't be long enough because the next resistance support level is only 15 or 18 pips away. You've got to balance it out. Sometimes it's not worth entering the trade. So many traders will actually look for much more than the number of pips risk, seeking a much higher risk reward, such as 1 to 3. And like I said, that's my golden ratio. So once you have this, you have to determine your strategy for trading. So this is what you're looking at. It's the typical breakouts of an event. So we see the first group of traders who react. There's always those traders who are going for the short-term immediate reaction. You have lots of volatility by people entering and exiting the markets. You don't necessarily want to be in that first group. That's high risk. That's knee-jerk reactions. Given the above complications, why even try to trade these events at all? Instead of trying to anticipate the market reaction, a more reliable approach for traders is to use a strategy which profits from volatility basically in movement in either direction. And that's one of the smart things to do. And you can take advantage. Volatile markets can be the trader's best friend if you can figure out how to hedge and straddle the markets and take advantage of moves up and moves down and learn how to set your stop losses and your order entries and learn how to take advantage of these. There are ways to do this, and a straddle works great. But this takes a whole different type of understanding. First, you have to understand the event, learn how to analyze them, learn how to isolate support and resistance, and then learn how to master different types of strategies. So if you want, you can give USG a shot, sign up for, enroll with USG, set up a demo program, take advantage of their education, learn how to use their order entries, and then be prepared to trade events like Friday's non-farm payroll report. Because it's coming this Friday. Now, today is Tuesday. You have 3 days to get prepared. You have 3 days to analyze. You have 3 days to figure it out. You have 3 days to figure out how you would want to build a strat. And that's the nice thing about economic events. You have lots of time to prepare. So remember, figure out what's market neutral, market positive, market negative, and then learn how to apply strategies. Now, you need to practice these using what I call OVV, observation, validation, and verification. And of course, maintain risk management at all times, because trading does carry a high level of risk. So don't get involved and try to get rich overnight, especially if you're going to start these out for the first time. Make small trades. Get them under your belt or use a demo account, because you'll find out in the long run, you'll make the profit down the road but don't risk losing your account. So thank you very much for joining us. If you want, go to www.usgfx.com, sign up for a demo account, and like I said earlier, this class has been recorded. You can access it in about 24 hours by using the same link you used to come to today's class. Thank you very much. Thank you for supporting investing.com, and thank you for giving www.usgfx a shot. They are one of the leading Forex providers out of Australia, and you'll feel safe and secure dealing with a well-known, reputable, regulated provider. Thank you very much, and we'll talk to you again real soon. Bye now.